Everyone's common laws had the same thing, and that is that physical metal, gold, silver, was final settlement and everything else was credit, including fiat currencies. That's the important point. They are credit. If you look at a gold-silver ratio of, 83, 84, I mean, this is plainly ridiculous. It should be 30 or lower. If you look at the level of debt in the United States, I mean, the US government's debt is about 115% of GDP. If the economy goes into recession, then that impairs the ability to cover those, to cover the interest cost, and indeed to service the debt. I put out a piece this morning, and one of the charts in there was the interest on debt. And I tell you, it's scary. It's just, it sort of goes along like that, and then, it's done that.
Central banks worldwide remained a key driver of gold demand in Q3, ramping up purchases following a two-quarter slowdown. Net gold purchases in the third quarter amounted to approximately 220 tons, marking a 28% increase from Q2 and about 6% higher than the 5-year quarterly average. In this deep analysis, economist and market strategist Alasdair Macleod explains how the global financial system is entering a critical phase 1, where confidence in paper money continues to erode. He points to growing central bank gold purchases and the ongoing weakness in major fiat currencies as proof that a quiet monetary reset is already underway. Recent reports show that global gold demand hit its highest level in over a decade, while silver's supply deficit continues to widen for a fourth consecutive year. Behind these numbers lies a much bigger story: nations and investors preparing for the inevitable repricing of real assets. This isn't a rally driven by speculation. It's a global shift in value and trust. The signs are all there. The next phase will catch most by surprise. If you appreciate real market insight, don't forget to like, share, and subscribe to the channel, your trusted voice on gold, silver, and the truth behind the financial system.
We are in a credit bubble. There is no doubt that bank credit has been expanded in favor of financial assets. And more than anything else, this is really what drives equity markets in particular. And we've seen this. We've seen this really over the last 2 years with the S&P rising from 4,000 or less or whatever. Currently, we're looking at 6,900, thereabouts. I never follow it that closely, but we're talking about a substantial rise. And the background to this has been a gentle drift in bond yields. They peaked, if you look at the 10-year, it peaked at around just a bit under 5%, I think, a couple of years ago. It's gone back and up and down. And currently, it's around about 4%. So that has been a fairly benign background against which there has been a substantial increase in the amount of credit aimed at assets. When Bretton Woods ended, there was a big propaganda effort by the US Treasury to persuade everybody that gold was no longer part of the monetary system. Now, I think it's important to know that that actually goes against common law. Common law is that gold is final settlement and everything else is credit. And this goes back to the first set of laws produced in Rome, which were at 448 BC. That was refined by jurors in the following centuries, and then incorporated in Justinian's Pandects. And of course, out of the Roman Empire came all the countries, the European countries, from the Urals, or if you like, from Russia all the way through to Portugal, who went out and colonized the world, including the great US of A. So everyone's common laws outside China and so on and so forth, which is somewhat different. Everyone's common laws had the same thing, and that is that physical metal, gold, silver, was final settlement and everything else was credit, including fiat currencies. That's the important point. They are credit. And the value of a fiat currency depends on two things. Firstly, the quantity of its issue, and secondly, the faith that its users have in the value of that currency. And the problem is that fiat currencies always come to an end. And we've had this regime now, based on propaganda, no more, for 54 years is coming to an end, in my view. Why is it coming to an end? It's coming to an end because governments use fiat currencies always as a means of accumulating debt without having to, if you like, keep the value of that currency tied to gold, which limits, it cramps their style. It really does cramp a government style. So you always find that these fiat currencies end in a massive mountain of debt. That then collapses in terms of its value or counterparty or bankruptcies or whatever. And so are we close to that point? I think we're getting pretty close to it, is my view. And when it happens, everything changes. Absolutely everything changes. And I think, I'm very glad I don't actually manage money anymore, but it seems to me that this is going to be very, very difficult for investment managers to handle. And this is why I say, I've tried to sort of say earlier on, and I know people have joined since we started this, that the first thing to observe is the bursting of the credit bubble, which has been funded basically by the expansion of bank credit. That's where bank credit has been going. That's why the S&P has risen by, 50, 60, 70% or whatever in the last 2 or 3 years. That's the first thing. Now, when it pops, when it bursts, then you will find that everything which people own in portfolios will be sold down, particularly where they've got profits, because they will, it's human nature. When it comes to the losses, you just ride them. But what you do is you liquidate the things that have been performing well, that you got good money on. So I think even gold mines would be sold out. But the one thing they haven't got is physical metal. They don't own physical ETFs, etc. And I think that when the bubble pops, you may have to count up to 10 or something before it happens. But the next phase will be bond yields rising, making the situation worse, foreclosures in the market. You'll find foreigners will be selling what to them are foreign stocks, and bear in mind they've got 16 trillion invested in US stocks. The whole thing is going to be a mess, a huge, great mess. And trying to manage your way through that, I think is going to be very, very challenging. And my strategy, I think, would be, get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, this is plainly ridiculous. It should be 30 or lower. So the two monetary metals, I think you take a position in those, then you've got to play the end of the bubble. And that basically means lightening up on rising prices from here, on tech stocks in particular. Bitcoin, incidentally, correlates beautifully with the Magnificent Seven. So if you've got that as well, I would get out of that. And when it comes to bonds, you don't want to be invested in duration. I know that insurance companies and pension funds look at matching, if you like, duration with their liabilities, of course. If you look at the level of debt in the United States, the US government's debt is about 115% of GDP. The ability to pay that comes out of the private sector, the taxes, if you like, that the financial and non-financial sector provide to the government. That's the important thing. Now, if the economy goes into recession, then that impairs the ability to cover those, to cover the interest cost, and indeed to service the debt. And that basically is what we're seeing. I put out a piece this morning, and one of the charts in there was the interest on debt. And I tell you, it's scary. It's just, it sort of goes along like that, and then, it's done that. That, if you like, is really what's happening with the debt trap. And that's why this can't be muddled through anymore. This is coming to an end. It's actually as simple as that. You need to look at the whole thing in the round. The idea that we can continue to run high levels of debt I mean, the other thing is that, we did have higher levels of debt. Most countries had debt to GDP of 160, 180, 200% at the end of the Second World War. But the difference then was that we were on the Bretton Woods gold standard. And that kept interest rates down, and it allowed for the expansion of credit, which was angled at production more than anything else. So it was inherently non-inflationary. So what you had was the ability to do yield curve control. That was the time of yield curve control. And you could also persuade investing institutions to act in a certain way. There was all this sort of, off-the-record briefing of institutions. So, but that cannot happen now. It just does not happen. You cannot have yield curve control. You cannot control the yields on the long end of the bond market. They're no longer controllable. And the fact that we're not tied to a gold standard, which is provides a severe limitation on inflation, if you like, the way prices behave, that doesn't happen either. So, this is an inherently different situation from the past, where we've had higher rates of debt to GDP and got away with it, but not under a pure fiat currency. That's the point I'm trying to make. And I think that is why we're coming to the end of a fiat currency era with everything that implies.
We're moving into a stage where illusion and reality can no longer coexist. The paper markets may still dictate daily prices, but the real story is unfolding behind the scenes in physical demand, in central bank reserves, and in nations quietly diversifying away from the dollar. Every ounce of gold and silver is becoming more than a trade. It's a statement of independence from a financial system stretched beyond its limits. As confidence fades, the system is being forced to reveal its true value. And that's where hard assets shine. The next move won't be triggered by speculation or headlines, but by necessity. When the tide turns, those holding real wealth will no longer need to prove they were right, the market will do it for them. If you believe in understanding before the crowd reacts, make sure to like, share, and subscribe to the channel, where insight meets preparation in the world of gold, silver, and financial truth.